I bought some physical silver, feeling that when the hate dissipated, that the price would go up, a dead cat bounce. And I wrote myself a little memo. We're going to talk about memos later. I wrote myself a little memo, why I did it. And I said, I think gold will do well. I think when gold establishes the momentum and the generalist buyer comes into the precious metals market, that at some point in time, silver will begin to outpace gold, and I'll get a nice bounce. Well, guess what? It happened. And I read the memo. The reason that I owned silver was because I thought the hate would dissipate, it would get a bounce, and I thought that silver could go to $50. I was wrong. It went to 75. And the same social media that had been so roundly condemning silver, you saw these headlines now saying silver's going to go to $300 or silver's going to go to $400. It isn't going to go through the roof, it's going to go to the moon. Wonderful time to take a little profit. So last week, I sold 80% of my silver stocks. And I was pretty public about it. And the social media condemnation of me was really gratifying. The amount of hate I saw immediately let me know that I had done exactly the right thing. I thought 2025 was going to be a pretty good year. I had no idea how good a year it was going to be. The consequence of that, when you have positive surprises, is often that you have unwarranted optimism. And so I understand that the mood here is euphoric today, and I'm going to rain on your parade, which is to say, to remind you, I guess, that you haven't actually made the money until you've taken the money. And so I want to talk to you about the psychology of selling and the necessity of selling. I want to talk to you about the futility of envy and the futility of the fear of missing out. I want to tell you that in circumstances where you feel the most confident, you need to feel cautious. And the point in times when you feel the most fear, you need to evidence aggression. It's an interesting thing, it's an easy thing to say, it's a very hard thing to do. But what separates winners from losers in financial markets over time is people who take advantage of the market that they're in as opposed to being taken advantage of by it. Those of you who have suffered through years of my lectures, and I know there's a lot of familiar faces here, will know that I believe that capital-intensive cyclical businesses are extremely volatile and that you have a choice.
The 1970s were a decade of extremes. Gold from $35 to $850, silver skyrocketing from $1.50 to $50, and natural gas surging tenfold. I rode these waves, believing my gains were proof of brilliance, but I was riding the winds of fortune, not skill. Markets are cyclical. High prices attract risk, low prices inspire despair. Many young investors suffered flat portfolios for over a decade. Personal experience teaches humility. Wealth achieved in a bull market is not permanent unless carefully managed. The lesson: cycles reset, and the smartest move is often timing when to extract gains.
You must either be a contrarian or you're going to become a victim. Now, the problem with that is that most people want to be contrarians when it's, how would you say, popular, which is sort of a contradiction in terms. And so I want to talk to you about real contrarian activities. That's really what the subject of today is about. And I like to begin, as I often begin my contrarian speeches. Some of you will know that it was expropriated from me incorrectly by Ross Beatty this morning. In 1984, I was in a town in West Texas called Midland, Texas, an oil town. And in 1984, after the collapse of the 1970s oil market, Midland was really hit. 40, 50% commercial real estate vacancies, that kind of stuff. And I saw a bumper sticker. It said, "God, please give me one more bull market. I promise not to waste this one." Now, if y'all will think back to 2020 or 2021, how despondent you were all metaphorically wearing that bumper sticker. I'm in these junior stocks. I have the faith. I have all this kind of stuff. But God damn, have I been tested, I need a market. Well, you have a market now. Don't waste it. Don't round trip it. I'm not saying to quit it. But I'm saying don't waste it. Where do I want to go with this? I want to go a few places. I'll tell you a personal story that's not unlike the bumper sticker. In the decade of the 70s, I emigrated to Vancouver, British Columbia. And I was extremely lucky to do that. I emigrated into a very pleasant place to live, but more importantly, the story, the epicenter of speculative resource stocks in the world. Those of you who weren't here in the 70s missed something truly special. One of the wildest places in human history. And I got to witness it a bunch of ways. One of the things that happened is that I was interested in natural resources, which is what the town did.
Contrarian investing is rarely fashionable. True contrarians act against popular sentiment, not alongside it. Midland, Texas, 1984, after the oil crash, illustrated desperation. God, give me one more bull market. People yearn for highs after prolonged lows, often overestimating their judgment. The challenge is resisting herd mentality during euphoric rallies. Being a contrarian isn't merely being different. It's strategic discipline, selling when others buy and buying when others panic. Recognizing overvaluation, market euphoria, and sentiment extremes allows investors to protect gains, reduce risk, and position themselves advantageously for the next cycle downturn.
And other young people, particularly young men in financial services, who weren't in resources, witnessed one of the ugliest bear markets in human history. A market where the major index, the New York Stock Exchange, was flat for 14 years. So young men that I was competing against were watching a pubic hair get shaved off of their portfolio every day for 14 years, while I was experiencing these radical upturns. It was fun for a while, you know? Really, truly was. My problem was, in the decade of the 1970s, and some of you are going to begin to personalize this now, my problem is that I confused a bull market with brains. I made a bunch of money. The gold price went from $35 to $850. Natural gas price went from 30 cents to $10. Silver price went from $1.50 to $50. I made money, and I thought I made money because I was smart. That's almost catastrophically stupid. Not understanding that the winds were in my sail. A second mistake I made is that I didn't understand that markets are cyclical. I didn't understand that the cure for high prices is high prices. Cure for low prices is low prices. I remember in 1980 or something reading some paper, it might have been the Financial Post, I don't know what it was, and it had consensus views of oil price, you know, had the International Energy Agency, had the US State Department, had the Royal Bank, had that collection of morons known as the Club of Rome. And the consensus view of the oil price, oil having gone from $3 to $30, was that oil was going to go to 200. And given that I was long oil, that was an extremely seductive thesis for me. The problem is it was wrong. And I won't bore you with the whole story, but I went from being an extremely wealthy and hubris-ridden young man. I don't mean Rockefeller wealthy, but I mean by the standards of 24, 25-year-olds, stupidly rich.
One key principle is simple. Realize gains before they evaporate. In 2025, I publicly sold 25% of my junior resource stocks during an extraordinary rally. Critics erupted on social media, yet this sale returned all invested capital and mitigated downside risk. By reclaiming capital, future speculative trades could be made with house money, reducing personal exposure. The lesson, profits on paper are meaningless until converted to real capital. Investors must evaluate risk tolerance, timing, and personal circumstances. Avoid overconfidence and never confuse market wins with personal genius. Strategic exits define longevity in markets far more than entry timing.
To having a net worth that was negative, which is to say south of zero. And that was not a good thing, except that it taught me very, very, very dramatically, first of all, just how smart I was, which is to say not very, and also that markets are cyclical. It was good in the sense that it taught me the lesson of cyclicality in a very personal way. I remember in 1982 that my investment goal My investment goal, what I was striving for, was to get myself back to broke. I knew if I could get myself up to broke, I'd be okay, because I was a good earner, I was a smart guy, I was a good saver. But if you think about a market where your goal is to get yourself back to broke, you will understand the impact of that bear market on me. And I personalized this because I remember the despondency in this room in the COVID period. People were saying, yeah, Rick, we get the narrative, we get the demise of the US dollar, we get the underfunding of exploration, we get all this stuff, but the stocks go down. First of all, understand that a thesis that you know and like that becomes cheaper is a sale. If you thought about buying stocks the way you bought coats, you'd do pretty well in any kind of market. But the second thing is that I want you to remember the despondency that you felt then, the caution that you felt then, the cynicism that you felt then, and ask yourself how you'd like to feel that way again, because these markets are cyclical. We will go back to the despondency in 2020 and 2021. We will go there. I make very few guarantees in my life, but I absolutely, positively guarantee that at some point in time, by the way, I can't tell you when, we will go back there.
Investors face two types of mistakes: errors of omission and errors of commission. Omissions occur when opportunities are missed or profits left unrealized. Commissions occur when active decisions result in losses. Errors of omission are far more tolerable than errors of commission because at least no capital is destroyed. Selling part of a portfolio may leave upside on the table, but preserves capital. Over decades, disciplined capital preservation has proven more profitable than chasing every market peak. Understanding personal risk appetite, cost basis, and portfolio objectives ensures actions remain aligned with long-term success, particularly in volatile, capital-intensive sectors.
Why am I telling you that? Because the title of my speech is Make the Money, Take the Money. In the 1970s, I rode the boom all the way up and then all the way down. And it was a lot more fun on the way up than it was on the way down. But it would have been more fun yet had I been able to take some money off at the top and redeploy it at the bottom, which I wasn't able to do. I have been able to do it since. And I want you to think about that in the way you operate your own account. Now I'm going to personalize it for you because many people ask me questions about portfolios, assuming that there's a one-size-fits-all answer. And that's wrong. If there's 8.4 billion people on Earth, there's 8.4 billion answers to every question. Not every strategy is appropriate to every person. And you need to look at your portfolio and the constituents of your portfolio in the context of your own personal circumstance, your knowledge, your risk tolerance, your time preference, all of those things. So a technique that I describe or a circumstance that I describe really is personalized to me. It may not be acceptable for you. I hope you get that. And I'm going to talk about a couple of circumstances in the next 3 or 4 minutes. And I'm not suggesting that these circumstances, these actions which I took are appropriate too, but I want to talk about these actions in the context of making and taking the money. I was fairly well publicized in October of 2025 as saying that in my belief the market had run too far, too fast. And I sold 25% of my junior resource stock portfolio during a point in time when the GDXJ price chart was, in Canadian parlance, a hockey stick. Just, it was straight up. There were no sellers, only buyers. And so I decided, as a public service, that I would be a seller. I'd make it a little easier for folks to buy things. I knew I was right, because as soon as I announced that the outpouring of hate that I enjoyed on social media, the incredible vituperative response that I made, let me know that I was making exactly the right choice for me. Why did I do that? Well, it wasn't just valuation. Personally, my portfolio, I had a large portfolio of juniors, and I was able, by selling 25% of my portfolio, to recoup all of the capital I had invested in the sector and pay the capital gains tax.
Sentiment drives short-term market swings. Silver, once despised and overlooked, surged far beyond initial expectations, illustrating the power of contrarian insight. Social media amplified both fear and euphoria, reminding us that perception often exceeds fundamentals and influence. By monitoring sentiment and market cycles, opportunistic positions can be established when hate is high and caution dominates. Timely profit-taking, even amid headlines of to-the-moon rallies, safeguards capital and reduces stress. Markets will always cycle between despair and greed. Those who plan for the extremes, who understand psychology and cyclicality, gain the advantage over those caught in emotional swings.
In very simple terms, I sold off 25% of my upside and I eliminated my downside. As a gambler, I get pretty aggressive with the house's money. And now in speculative markets, I'm playing with the house's money. My money, my bait, is back in my dip. I made the money. I'm on the house's money. Now, a lot of these stocks are up since then. Do I feel bad? Nah, not at all. And I want you to write the next part down. This is important. If you have a pencil, you have a pen, something, write this next part down. There's two kinds of common error in investing. Two kinds. The first is the error of omission. Okay? Omission. The second is the error of commission. Let's talk about these two. Omission is something that you didn't buy that goes up, or something where you sold too soon. You omitted some of the profit. Commission is where you do something and you lose money. Errors of omission are better than errors of commission. Learn this for the rest of the time. I sold a basket of juniors. Let's assume, just for fun, that they double. Okay, I already enjoyed a five-bagger, so I left the last piece on the table. I'm not happy about that trade. I'm ecstatic. Ecstatic. I'm not saying that everybody here should go out and sell your juniors. Many of you don't have the low cost base I had. Many of you have them in a different quantum. Some of you may have a more aggressive feeling for the market that we're in. All I'm saying is that you need to decide how you will feel if your thesis around the bull market is wrong and we revisit 2020 or 2021. That's all I'm suggesting that you do. Fast forward. A couple weeks ago, maybe 5 years ago, if you looked in popular media, social media, about silver, everybody hated silver. They thought parenthetically the silver was a four-letter word. You know, people that thought there was going to be a silver squeeze and missed out, or whatever the drill was. People hated silver. So I'd probably better buy a little bit of silver. There's a lot of hate in the market, so I bought some physical silver, feeling that when the hate dissipated, that the price would go up, a dead cat bounce. And I wrote myself a little memo. We're going to talk about memos later. I wrote myself a little memo, why I did it, and I said, I think gold will do well. I think when gold establishes the momentum and the generalist buyer comes into the precious metals market, that at some point in time, silver will begin to outpace gold, and I'll get a nice bounce. Well, guess what? It happened. And I read the memo. The reason that I owned silver was because I thought the hate would dissipate, it would get a bounce, and I thought that silver could go to $50. I was wrong. It went to 75. And the same social media that had been so roundly condemning silver, you saw these headlines now saying silver's going to go to $300 or silver's going to go to $400. It isn't going to go through the roof, it's going to go to the moon. Wonderful time to take a little profit. So last week, I sold 80% of my silver stocks. And I was pretty public about it. And the social media condemnation of me was really gratifying. The amount of hate I saw immediately let me know that I had done exactly the right thing.